Here to get into all that is Dan Greenhaus of Solus Alternative Asset Management. Dan, good to see you.
Thank you for having me.
Thanks for coming by. Listen, there's always something to worry about. We can always make a list of the concerns. We talk about that all the time. But really, the markets in aggregate, whether you look at credit spreads, you look at volatility levels, you look at the all-time highs on a weekly closing basis, the breadth of the market even, the market's kind of telling you to relax. I think the question always is it safe to do so, or are we missing anything that could spoil this?
I mean, you touched on it right at the outset there, that you and I and you and any number of guests have constantly talked about all the various things that we've been told to worry about over the last 1, 3, 5, even 10 or 15 years if you're as old as we are. And each time the market has defied those odds. It's not just the Fed, it's not just earnings, it's not just geopolitics. There's a little bit of everything that has helped drive markets to the all-time highs at which we currently find ourselves. I would say, as someone who's been relatively optimistic on assets for some time, and certainly since the bottom, the market rally is not quite as broad. Excuse me.
Sure.
I checked my investment account earlier. I'm choking. We're at all-time highs. It's not quite as broad as I think I would like. I looked, the market's at an all-time high. Only about 50 stocks in the index are at all-time highs. Yeah. Previous instances, you'd like to see double or even more than that. But year to date, the S&P is up, whatever, 7 and change %. Roughly half of the index is up more than that, half the index less, which is perfectly normal in any given year.
Right. And I think, I mean, granting that, you know, the longer term your outlook and the broader your aperture, you know, the more comforting it is to say, listen, don't worry, stay the course. But I do think along the way, you want to go back 15 years, we can talk about lots of 20% sell-offs. We can talk about lots of genuine macro scares. So I think, to me, the question is, look, 3 months ago, it was possible to say, we've priced in something like peak uncertainty on the policy front. We've had this panic, this liquidation type move. All you need are things to be less bad, and we're fine. Now, above 22 times earnings, we can slice and dice the valuation all you want. It's hard to get around the idea that it's not a full valuation. And with everybody seemingly taking the bright side of the tariff question, I just wonder if it's about, sure, we may continue to get positive developments, but the market now is sort of positioned for them.
Listen, I'm with you on the tariff side of the argument. There's a lot of optimism about tariffs, and somewhat deservedly so. The macro data hasn't really reflected it. And so you look at the import number the other day, if you're someone who looks at the macro data, that's evidence that maybe some exporters are bearing their share of the burden, so to speak. I disagree on the valuation side of things, and you know this. I mean, we've been told the market's been overvalued for 5 to 7 years, ever since the tech breakout really began, certainly post-COVID. And the valuation at no point has prevented the market from making new highs. And I would also add, look at Caterpillar, look at Boeing, look at Tapestry and Ralph Lauren, couple of the utility names, granted they're AI derivative utility names. There's a broad swath of companies that are doing quite well. Netflix, Delta and United just reported. Now, obviously, the reaction to some of these names has been less optimistic, and part of that's because we've had a big rally into earnings, and so there's some element of digestion here. But you look at the swath of companies that have reported, obviously the big banks, but also, as I mentioned, Netflix, Delta, even something like SL Green, which talked about strong demand for Manhattan real estate. They're telling me things are okay. And I get it that conference calls are, in some respect, marketing gimmicks. But when you take them together, they're telling me things are okay. And when things are okay and earnings are doing what they're doing and the economy is doing what it's doing, why shouldn't stocks be higher?
Yeah, you definitely don't typically get some kind of real reckoning on the valuation front
until it's time to have
growing.
Yes, that's right.
Or the Fed's tightening hard or something like that. On the other hand, I mean, look, I'm here. I'll make fun of like CFAs all day, but like, what's the point of doing investment analysis if what you pay today does not have some bearing on longer-term expected returns?
Well, listen, that's perfectly fair. And as someone who has completed 2/3 of the CFA and gave up on the third level, the CFA Institute, fine.
Does great work.
Sure, it does great work. Although someone just got convicted of embezzling money, but that surely didn't take the ethics portion of the test. But I mean, listen, valuation tells you something about the risk and risk-on sentiment, et cetera, et cetera. And when the time comes for sustained equity decline, obviously there's further to fall from higher valuation levels than lower valuation levels. That is what history tells you, not that in any given 6-month or 1-year period that valuations are a binding constraint. They're not. And so to the point about the work that we do, I mean, listen, we're a single stock manager, a single credit. We're trying to find names that do well in any environment. And so that type of work is what we do, and obviously what millions of people across the investment landscape do. But you have a tailwind at your back right now in the form of an economic story, in the form of the AI development, and a risk on sentiment that pervades the market. And with that, a stock that normally trades at 1.2 times the market, 1.3 times the market on a PE or an EV/EBITDA basis might trade at 1.5, 1.6, 1.7. And when I say might, I mean definitely, because that's what we've seen. And so in that sense, the work needs to be done, but until, as you mentioned, the Fed raises rates and cracks the economy or something like that, until then, it doesn't really help inform the investment process. You're looking for companies that are performing in the environment in which we find ourselves. And in that sense, the companies that have been doing well are doing well for a reason.